In your 20s, you stand at the crossroads of unparalleled freedom, the dawn of adulthood, past school and free from heavy commitments. It's a time of exploration and growth while many peers may live in the present. The savvy ones see it as the prime time to invest. Starting now can yield immense financial rewards, blending the thrill of the present with the promise of a secured future. Your 20s are about seizing the moment while building for tomorrow. Ready to dive into investing but unsure where to begin? Let's explore 7 key tips from leading financial planners nationwide. So, here are 7 smart investing tips for 20-somethings. Tip number 1. Start investing now to harness the magic of compound interest. In your 20s, you might feel you've got an eternity to sort out your finances. After all, you could be around for another 60, 70 years, right? So, what's the rush in starting to invest now? However, delaying can cost you substantially. Take this scenario from financial advisor Mitchell Bloom of Bloom Financial LLC. Imagine investing $300 every month from age 20 to 60. With an 8% return, you'd accumulate over $1 million. But start at age 30, and by 60, you'd gather only $440, essentially waiting a decade to invest. And your $36,000 in contributions would rob you of over $550,000 in returns. This remarkable growth is attributed to compound interest, which Einstein famously revered as the world's 8th wonder. It's the interest you earn on your initial investment, plus all the accumulated interest from previous periods on a deposit. Jude Wilson of Wilson Group Financial aptly puts it: compound interest is the universe's most potent force. Its magic intensifies over time. So starting young is key by not leveraging it early. You're sidelining potential gains that you can't reclaim later. So, to truly secure your financial future, tap into this magic sooner rather than later. Tip number 2. Consider investing as part of a broader financial plan. Investing early can be a catalyst for wealth building in your 20s, but it's not a one-size-fits-all remedy. Josh Bryan, a renowned financial advisor from Seattle, emphasizes the importance of a comprehensive view of one's financial well-being. Before diving headfirst into investments, it's imperative to introspect: are you grappling with student loans or burgeoning credit card debts? Is there an unchecked spending pattern that's eroding your savings? Brain points out the futility of trying to invest your way out of debts or unchecked spending habits. Rather than chasing the latest trending stock, Bryan advises young investors to hone their focus on core financial disciplines, cultivating sound spending habits, effectively managing debts, consistent savings, and meticulous budgeting. In essence, while a well-stocked retirement fund is commendable, it's rendered ineffective if you're submerged in debts and lack financial discipline. Tip number 3. Realize that money is a tool. If you're in your 20s and ready to build wealth, it all starts with recognizing the money you earn is nothing more than a tool, says financial advisor Eric C. Jansen of Aspen Cross Wealth Management. Rather than perceiving the money you earn merely as a remedy for your challenges, approach it with a broader perspective. See it as a versatile tool at your disposal, empowering you to meticulously craft the life and lifestyle you've always envisioned. Through judicious decisions about spending, saving, and investing, you have the potential to transform your financial narrative and align it with your aspirations. Learning to become a diligent saver and investor early on is the key to being able to live the life you desire, says Jansen. While you're trading your time for money today and the future, you will be able to use your money to give you the time to do more of the things that really matter in life, utilizing the earnings you accumulate as both a tool and a guiding compass. Expert Jansen recommends categorizing your objectives into immediate and distant goals, subsequently selecting investments tailored to achieve each. When aiming for near-future targets such as pooling funds for a home purchase, it's wise to lean towards more conservative investment avenues like bank CDs, savings, or money market funds. However, when visualizing far-reaching aspirations like retirement or achieving financial autonomy, it's beneficial to adopt a more assertive investment stance. This is because the extended time frame allows you to weather the inherent volatility of stock markets, ensuring a balanced growth trajectory. Jansen notes. Tip number 4. Gradually increase your savings as you grow older. In your 20s, the bucket list is long: a new home, a car, global adventures, all while thinking of the distant future. All at a time when you should also save for the future. Financial advisor Alex Whitehouse of Whitehouse Wealth Management suggests beginning with modest investments and increasing them over time. This approach not only supports retirement savings but also accommodates other financial objectives. Whitehouse suggests beginning your savings journey by setting aside just 1% of your income. Gradually, as time progresses, increase this by an additional 1% annually. By the time you're in your 30 assets, you'll be comfortably saving a tenth of your income. As the years roll into your 40, this savings rate will climb to a significant 20%. The beauty of this approach lies in its subtlety. If you're fortunate to receive yearly raises, this incremental increase in savings may not even dent your spending habits, making it a seamless transition to a robust savings routine. Tip number 5. Don't compare yourself to others. Chart your own financial journey. Don't try to keep up with Joneses or the Kardashians, says financial advisor Jamie Pomeroy of financialgusto.com. Instagram, Facebook, Twitter, and Pinterest are full of pictures and stories of your friends and strangers' unblemished lives. The allure of not wanting to miss out often nudges the younger generation into a race of comparison. Such mindsets might push them into expenditures beyond their means, accumulating debt and sidelining essential yet seemingly mundane tasks like saving and investing for the future. While your friends traversing the globe may portray an enviable life, it's likely that their lavish escapades aren't paired with a solid retirement plan. Those exotic getaways to places like Thailand, they might just be charged to their credit cards. Tune out the distractions and tune into solid advice to drive you to find money to start investing in your future, says Pomeroy. Consider this practical financial wisdom for your 20s. Kickstart a Roth IRA. Why? Well, the magic lies in starting early, because down the road, you might just discover yourself strolling through the vibrant streets of Thailand. And the best part, you'll be paying for it in cold hard cash. Tip number 6. Invest in your personal growth and development. Irrespective of the stock market's ups and downs or the volatile nature of cryptocurrencies like Bitcoin, there's one realm where you hold unassailable control. According to Colorado financial advisor Matthew Jackson from Solid Wealth Advisors, that domain is you. Jackson advises channeling your investments towards your personal, professional, and financial growth in ways that resonate with you. Why? Well, because nurturing your work ethic, honing your skill set, and amassing a wealth of knowledge can turn out to be the most rewarding investments you'll ever make. His counsel: immerse yourself in books, partake in conferences that align with your growth trajectory, and most crucially, translate the wisdom you gain into your daily life. There are few strategies as effective in securing pay raises or unlocking new career opportunities as vigorously cultivating your skill set. Remember, when you invest in yourself, the only way you move is forward, and if you're in your 20s, there's still ample time to further your education, obtain certifications that can propel your career, or embark on a new journey in an industry you've always admired. The power to shape your future lies within you. The journey of investing in your 20s is a crucial step towards securing your financial future. By heeding the advice of top financial advisors, starting early, prioritizing retirement savings, diversifying strategically, staying informed, and seeking professional guidance, you can build a strong foundation for long-term financial success. These expert insights serve as a roadmap for navigating the dynamic landscape of investments in your 20s and setting the stage for a prosperous financial future.